Yeah, very good evening, delegates. Welcome to the first day of a two-day seminar on tax audit and technology. Today, we have with us Abdul Kadir Jawadwala. Assalamu alaikum, sir, who will take us through overview of tax audit. I'm happy to introduce sir. Abdul Kadir is an associate member of our institute and a commerce graduate from Mumbai University. He is an all India rank holder at Inter CA as well as CA final level. A big round of applause and kudos to you, sir. He is in tax products in the field of direct taxes and has been with a leading Big Four firm for the past 4 years. He is also a part of tax controversy management team. As part of the tax controversy management team, he also handles litigation matters for clients at both the appellate forums, the dispute resolution panel, Commissioner of Income Tax Appeals, and the Income Tax Appellate Tribunal. Abdul Kadir also assists legal counsels engaged by the clients to appear on their behalf before the Income Tax Appellate Tribunal, High Courts, and the Supreme Courts of India. He has authored several articles on tax matters and has made presentation on different topics at various seminars and workshops. His professional mantra is keep integrity and your work ethic intact. So that means working a little harder, and honorable character is your best calling card, and that is something anyone can have. With this brief, I present before you Abdul Kadir Jawadwala to handle the session on overview of tax audit. Over to you, sir.
Thank you so much for such a warm welcome. I'll just present my screen. Just let me know if I'm audible and my screen is visible. Is my screen visible?
Yeah, yes, sir. Yes, sir.
Okay. So then I'll begin.
Yes.
A very good evening to one and all. As we know that the tax audit season is due upon us, and within a month's time we'll have the tax audit reports to be filed. So it is very imperative that we brush up on the various clauses, their implications, the recent amendments, and get an overview of tax audit by way of this session today. So in today's session, we'll be covering I think my screen is paused. Is it visible now?
Now I can see the contents background in conducting tax audit, that page. That is a PowerPoint presentation.
Yeah, perfect.
Yes.
Sure, perfect. So in today's session, we'll be covering the basics, that is the background, overview of tax audit, the challenges that are involved in conducting tax audit, the applicability, when tax audit will be applicable, the thresholds, etc. Basics in terms of the terms involved, which are contentious, which are not defined under the Act. We'll go through some of the key clauses. We know that there are 44 clauses in the Form 3CD, but we'll go through key clauses. We'll have to see certain relevant amendments by the Finance Act 2021 as well as Finance Act 2022. There are a few of them. Then we'll see certain checklists and miscellaneous type and some typical issues that we face while conducting the tax audit. So with this general overview of my today's session, I'll quickly move on to the background. So in terms of the background, I would say that the tax audit had been introduced by the finance minister in 1984-85, which is the assessment year 1985-86 was the first year where compulsory audit was introduced under the taxation statute to ensure that proper maintenance of books of accounts and other records were maintained by the assessees. So this amendment was brought in with a view so that the tax administration and the tax department are facilitated with proper presentation of the accounts before the tax authorities. And this would also save much time for the tax officers in carrying out the verification by way of from the returns that an assessee files. So the tax audit has been due upon from almost like 30-40 years now, but there have been constant amendments in the tax audit in terms of the Income Tax Act, which is amending the various sections. Now, why do you think that a tax audit was introduced? The main 5 bullets which I would say would be to maintenance of correct books and records, correct income should be disclosed with correct claims for deductions. A chartered accountant from the assessee's side needs to first verify that whatever is being submitted, whatever is being done by the taxpayer, that needs to be checked. Proper administration of the tax laws, and lastly, that it should save time for the tax authorities in terms of routine matters. Now, as we know that whenever a new section or a new provision is introduced, we get we have certain challenges to that section or to that provision. So similarly, this was before the Supreme Court in the case of T.D. Venkata Rao, wherein it was under challenge, and wherein it was observed that CA, by reason of their training, have special aptitude in the matter of audits, and the section 44 AB prescribing a chartered accountant to do such an audit would not violate Article 14 of the Constitution of India, and thus the constitutionality was established. Now we have seen the background, why the tax audit was introduced, why it was required, and when it was introduced. Now, what are the challenges that generally we as tax practitioners face while conducting the tax audit? Now, the first 3 I will be trying to cover with my best ability, so that we can be updated in after today's session. But the other 3 I would say would leave up to the situation and the circumstances, to say the least. So the first 3 is the amendments, the necessary amendments. As I mentioned, the Finance Act keeps on amending the income tax provisions. We have certain amendments which are going to be affecting us in the current tax audit cycle. Then we have certain case law updates. Now, certain decisions which are taken by various tribunals, the High Courts, Supreme Courts, which have an inert bearing on what stand or what position one has to take if there is any dispute or if there is any confusion. Similar help comes from the CBDT in terms of their circulars, notifications, etc. These are the challenges which one faces in 3 pointers, which become amply clear once we go through them. But there are certain other extraneous factors which I would say, such as lack of data from the client, certain time constraints in terms of the tax audit is in a busy cycle when one needs to complete. E-filing, very much relevant in today's time with the e-filing portal being updated. We are facing a lot of bugs and issues. And last but not least, we cannot take away the fact that there are 44 clauses that one requires to report, and that is an extensive reporting that is casted upon the tax auditor. So with these challenges in mind, let us navigate through a few important overview in the tax audit scenario. So first and foremost, one needs to understand, when I start to do a tax audit, is the applicability. Now, when is tax audit applicable to a particular assessee? It is very essential because there has been an amendment which is very relevant in the current year, which has increased the threshold, which was from 1 crore to 5 crore, and now it has become 10 crores. So a tax audit is not applicable if the turnover does not exceed 10 crores, but in certain cases where the cash transactions do not exceed 5%. So that limit is only applicable if your cash transactions, your income as well as expenses, both do not exceed 5%. So this is for businesses which are not under presumptive scheme. Now bullet numbers 2 to 6 would be considering those assessees which opt for presumptive taxation. So if a business is under 44 AD, then the turnover limit is 2 crores. For a professional opting for presumptive under 44 ADA, the gross receipt exceeding 50 lakhs, the tax audit would be applicable. 44 ADA, if the claim of income for certain professionals who have opted for presumptive is below 50% of the gross receipt and his income exceeds the non-taxable threshold, then tax audit kicks in. Fifth, business using 44 AD and falls under 44 AD subsection 4 and the income exceeds the non-taxable threshold. And then we have the 3 criteria, the 3 classes in presumptive: 44E, BB and triple B, where the claim income is below the deemed income. Now, why is it essential that one has to look at the thresholds very carefully? Because if you fail to apply the threshold in the correct perspective, there is a penalty for getting your books of accounts audited, or in the other manner of furnishing the report under section 44AB. So the section 271B prescribes penalty at 0.5% of the total sales or turnover or gross receipts, or rupees 1.5 lakhs, whichever is less. So this is the penalty if there is a failure of getting the books audited or furnishing the tax audit report. Now, apart from seeing the threshold limits, there are certain exemptions from the tax audit provisions. Now, section 44B and 44BBA, in case of non-residents, and in case of non-residents, these sections are applicable. Especially the 44BA, BBA is applicable in case of a non-resident operating in aircraft businesses. So, irrespective of the threshold criteria, they have no tax audit applicable. Then we have certain conditional exemptions. Few of them I read out in the previous slide as well. That is section 44AE, AD, ADA, which clearly stipulates that if you have opted for presumptive taxation and your income exceeds certain limit, then probably you will have to get yourself audited. So moving on, what would I call as basics? Now, before I move on to basics, there are certain terminologies that section 44AB prescribes, that your turnover, your gross receipts, your sales should exceed certain percentage. But what do you mean by sales, turnover, gross receipts? You should be in a business or profession. But what do you mean by business or profession? So these are certain terminologies that what would one mean by business under 44AB? So that is very well defined under the Income Tax Act under section 213, which stipulates that business would mean any trade, commerce, manufacture, or adventure in the trade, commerce, or manufacture. So business is very widely worded. So any trade, any commerce or manufacture, or even an adventure in the nature of the three stipulated above would be considered as business. Similarly, profession is also defined in 236, and it says that it includes vocation. Now, since the definitions given are very widely worded, these have gone before the various courts, and Supreme Court in the case of Manmohan Das had said that whether a particular activity can be classified as business or profession have to be determined on the facts and circumstances of each case. So there is no, I would say, a short formula that if a particular is termed as business, it should be termed as business for all. So one has to see the facts of each case to necessarily fit into the definition of business. Similarly, in the case of P. Stanwall and Company, the Allahabad High Court said that all professionals are businesses, but vice versa, I cannot say that all businesses are professionals. Only those businesses are professions, the profit of which is dependent upon the personal qualification and in which no capital expenditure is required. Now, why this is very essential? Because when we see 44ABA, the definition says that certain professions under 44A. Now, we would be confused. What can one say whether this is a professional or this is not a professional? So the court has laid down a simple test that a business can be called as a profession if a personal qualification, such as we as CAs, chartered accountants, have this personal qualification, and in which a capital expenditure is not compulsorily required, or if it is required, it is small in amount. So this was the test that was given. Now, business and profession was very well defined within the act, so one could borrow its meaning. Now, turnover, gross receipts, sales, the terminology is not defined under the act, but the guidance note that the institute has issued, which has been revamped, republished again in 2022, it throws some amount of light to help the professionals in understanding what would be categorized as turnover, what would be included, what items should be excluded. In a simple gist, when I say turnover for the purpose of this clause means aggregate amount of sales that are effected or services that are rendered by an enterprise. So when I say sales tax, excise duty are included in the sale price, there has to be no adjustment made in the turnover. And when I say sales tax and excise duty, wherever, GST has already been included by the institute in this guidance note. So the term goods and service tax has to be read in consonance with sales tax and excise duty. The third important bullet here is that trade discounts from sales can be deducted, but commission allowed to third parties cannot be deducted from computing the turnover to check the threshold. But however, if excise duty or sales tax or GST is recovered separately and credited to a separate account, and payments to the authorities are debited in the same account, then they would not be included in the turnover. Lastly, it says that sale of scrap, if shown under miscellaneous income, will have to be included in the definition of turnover. Now, there are certain examples which are given in the guidance note itself, which are very crucial for us to go through and remember what to be included, what to be excluded. Now, discount in sales invoice will reduce sales price and hence it can be deducted. Cash discount is in the nature of finance charges, so it does not have to be deducted from the figure of turnover. So trade discounts have to be deducted, while cash discounts, they say, should not be deducted from turnover. Special rebate can be deducted if it is in the nature of trade discount. So they are very well clear that you can give any terminology to any of the discount, but the nature would remain the same. If it is tax trade discount, it has to be deducted from the turnover, while if it is in the nature of cash discount, it has to be included in the turnover. Next, what about goods that are returned? So these have to be deducted from the turnover. Sale proceeds of fixed assets, these will not form a part of the turnover. Sale proceeds of property held as investment property, again, will not form part of turnover. And sale proceeds from securities, shares held as investment, again, these are investments, these are not stock in trade, hence they will not form part of the turnover. But there are certain businesses which are into investment activities, so for them, any transaction in shares, securities, debentures will form part of turnover. Now we have seen the definition of turnover. What is essential is to see gross receipts. Now, gross receipts is used in consonance with professionals, that 50% of the gross receipts have to be taken as taxable amount in 44 ADA. So what is gross receipts? Again, it's not defined under the act, but it says that all receipts which are in cash or in kind arising from the business will normally be assessable as business income. Now, gross receipt is a commercial term. It should be construed according to the method of accounting that is regularly employed by the assessee. So this is very crucial because professionals, we as professionals would follow certain mercantile, some of us would follow cash system of accounting. Hence, it says, the guidance note gives us guidance that gross receipt should be read in consonance with the method of accounting employed. Now we have seen the overview so far. When is tax audit applicable? We have seen the terminologies to help us understand the threshold to which just a moment.
Sir, hello.
Yeah, is my screen visible?
Yes, visible. So it says forms to be used, that page in a PDF.
Okay, perfect. Sure, perfect. So what we saw previously was, when is tax audit applicable? What are the terms which are crucial in determining those thresholds for which tax audit to be applicable? Now, when one determines that tax audit is applicable to an assessee, what are the different forms that are to be used? Form 3CA, where an account is to be audited under any other law. 3CB is to be used when a person is carrying business and profession but is not falling under category 1 above. And 3CD is the tax audit format where we have the clauses written. So this is the general forms that are prescribed under Rule 6G of the income tax rules. Now with this, we move on to certain key clauses in Form 3CD. So clauses 1 to 8A form part A in Form 3CD. These are general clauses which I will go quickly through because there is not much into detail. such as name of the assessee, the PAN, the status, etc. But what is essential for me to pause here is clause 8A that has been newly introduced with effect from 1st April 2021. Now, the background to this is that the finance minister had introduced the new tax regime under 115 BA, BAA, BAB, BAC, and BAD. Now, this has been incorporated under the tax audit clauses, and the tax auditor needs to report whether an assessee has opted for the new tax regime or it's continuing under the old tax regime. So this is just yes and no reporting. But what is more essential from tax auditor's point of view is that we not only rely upon what the management says that we have opted for a particular year. Now this is the second year probably in which we will be assessing whether the assessee has opted for the new regime. So what is essential is that we check that in the previous year, if they have opted for the new tax regime, whether they have filled in the necessary forms under 10IB, ICAI, and accordingly we then put in a yes or a no, rather than relying upon the management saying that we will be adopting, because these clauses, these sections of new tax regime are very restrictive, that once you have opted for, you cannot opt out. Hence it is essential that we report in the correct manner. Similarly, now we move on to clauses in part B from clause 9 onwards, which is in relation to partnership firms, where names of the partners, members of AOP, their profit sharing ratio, etc. needs to be mentioned. Clause 11 is essential, which prescribes whether the books that were prescribed under 44AA have been maintained by the assessee, that needs to be reported. Clause 12 states include any profits or gains on presumptive basis. So presumptive income, whatever the assessees who opt for presumptive taxations would be covered here. Clause 13 necessarily reports on the method of accounting and the necessary clauses of ICDS, and if any there is adjustment or impact to the net profit which needs to be undertaken under the ICDS, that needs to be reported. Clause 14 we have on valuation of closing stock and deviation from 145A. Now we have seen certain clauses. Before we move on to further clauses, there are certain amendments that have been happened or which we would like to deal in detail. One such clause is clause 4. So it says that goods and service tax registration number needs to be mentioned, and this is one of the clause 44 which we have on the screen, is the newly introduced clause which is going to be applicable from this year onwards. So it was introduced earlier, but it was kept in abeyance by circular number 5 of 2021 up till 31st March 2022, and beyond that there has been no circular which has extended that time limit. Hence it is understood that this clause will have to be reported for the first time during this year. We will get into this clause in detail because the guidance note covers this clause specifically, and hence we'll take up later on when we go clause by clause. Now when I say what are the issues, now whether the assessee is liable for indirect taxes, is a tax auditor required to opine on? So we have seen that GST registration numbers the tax auditor has to provide. So is that the tax auditor has to come to a conclusion that assessee is liable for indirect tax or not, and to check certain thresholds? So the guidance note says that the auditor is required to just give a factual detail basis the management representation that these are the applicable indirect tax laws, and accordingly one has to obtain the necessary registration numbers and report or disclose them in that particular clause, and is not required to get into the detailed applicability of the indirect taxes. That's very clear from the guidance note. Now we move on to clause 16A, amount not credited to the P&L but falling within the scope of section 28. Now this clause, why would it be very essential? Just to spend a few minutes, is there has been an amendment, though from 1st July 2022, bringing in section 194R, which says that a person is required to deduct taxes on any benefit or perquisite. Now this requires a person to deduct TDS, but similar provision was already there under section 28(4) of the Act to report if there is any benefit or perquisite to the assessee. So payer is required to deduct under 194R, but the person to whom the benefit of perquisite accrues, that provision stood before the amendment of 194R. So hence it is very imperative now that we as tax auditors ensure that if the assessee has received any benefit of perquisite in the business or profession and taxable under 28(4), but which is not credited to the P&L, the same should be reported under clause 16A. Now there are certain important judicial precedents in terms of Mahindra and Mahindra, which says that there are certain benefit of perquisites if they are in the nature of cash receipt, they cannot be taxed under section 28(4). Similarly, the Mumbai ITAT had said in the case of Priyanka Chopra that receipt of Toyota car, so this was not a this was in kind for promotion of Toyota's campaign, is taxable under section 28(4). So these are a few important judicial precedents which would help us in determining what would be a perquisite or benefit under 28(4) and reporting it accordingly. Clause 17 would deal with transfer of land or building, or both under 43CA and 50C. So these are those sections in business income and in capital gains, vice versa, wherein if a land or a building is transferred and the stamp duty value varies, then necessary disclosures have to be made by the tax auditor in the tax audit report of such a transaction. Important point to note is that if there is a residential unit where the consideration is up to 2 crores and is transferred between 12 November 2020 and 30th June 2021, and difference is up to 20%, otherwise the difference allowed is up to 10%. Now, when I say that clause 17, what would be the basic issues that one would face? One would face that what happens if the builder has adopted a percentage completion method for recognition of revenue? Each stage and for each year as on the date of transfer or any other date, what would one consider? So these are certain issues which have not been addressed by the guidance note. The leasehold rights, whether one would say that the leasehold rights would be covered. So similarly, these are the contentious issues for clause 17. Now moving quickly to clause 18, depreciation needs to be reported. But what is essential point that I would want to cover or highlight upon is that with effect from 1st April 2021, there has been an additional disclosure under the depreciation schedule, which definitely relates to the new tax regime under 115 BAC and BAD. Second important is adjustment made to written down value of intangible asset due to goodwill. Now, if one recollects, there has been an amendment by the Finance Act 2022, which states that depreciation on intangibles, including goodwill, which is in the nature of goodwill, is not to be allowed. So one will have to write down the value of the intangible asset block by that value of goodwill. So that is an important consideration which one will have to keep in mind. Now we move on to clause 21A. Now clause 21A, clause 21 per se has various subclauses from A to going on. What is essential and what are the relevant changes or amendments? I would like to cover those in particular. Now, first one is expenditure by way of penalty, fine, or violation of any law. So this used to come from section 37(1), which has been recently amended by the Finance Act 2022. When I say Finance Act 2022, it is very imperative that these amendments should not have applied to the year under consideration when the tax audit is to be done. But since these were issued under clarificatory in nature, which meant that from the time these explanations were in force, these have to be applied. Whether one would have any implications for these is a question. So earlier there was this controversy whether violation of law, what would one mean by penalty or fine for violation of law? Would it be only restricted to laws in India or any law under the globe? So that controversy has now been raised, and it has been said that no, when we say that penalty or fine for violation of any law, any means it would include even foreign laws. So hence, recently the Supreme Court, we would know that recently the issue of medical freebies in the case of Dolo is currently under scrutiny. Dolo 650 for giving various freebies to doctors. during the COVID period. So such was another example in which Supreme Court analyzed Section 37 for Apex Laboratories and held that expenditure which these pharmaceutical companies are incurring, which are in violation to the regulations given by the Indian Medical Council, should never be allowed as expenditure under Section 37. So this has also been one of the landmark ruling which has put a certain type of litigation to rest. 21B
Sir,
is in particular.
seems to be passed actually. Is it passed? So sorry to interrupt.
Sorry,
It seems screen is on forms to be used page itself, sir.
Acha, okay, sorry.
As of now, we are in which page, sir?
We have come on to clause 21B.
Okay, so
Is
anyway,
it
this will
visible
be
now?
shared at the end of session, right, sir? Yeah, it's visible.
Sure,
Clause
sure.
21B pages.
Sorry. Sure. So 21B, so clause 21B covers amounts inadmissible under section 40A. So these are the various clauses where TDS is required to be deducted, and if it is not, if these amounts become inadmissible on non-deduction of TDS, so these amounts have to be reported. While the non-deduction of TDS again gets reported under another clause. Similarly, we have C, D, which are the other clauses. But what I want to highlight is clause 21H, which is at the bottom of a screen. So this is also as a result of an amendment brought by the Finance Act 2022. So there are three amendments which were clarificatory in nature. One was 37(1), which we read about the foreign law. Second one is on section 14A, which clearly states that disallowance under section 14A will have to be made even if there is no exempt income earned during the year. So such an amendment is again clarificatory in nature, and one will have to analyze what are the necessary implications while disclosing under this particular clause. Now we move on to clause 29. So these are those clauses where 56(2)(7)(b) gets triggered and needs to be reported. 56(2)(7)(b) is particularly for those companies which are private companies, so which are not public company, and they receive consideration from a resident in excess of fair market value for issue of shares, but obviously subject to certain exceptions. So this clause is applicable to those cases where they have issued shares which is at a premium, and the fair market value which is determined and the price at which it is issued exceeds the fair market value. For an example, if a 10 rupee share is being issued at a price of 50, while the fair market value is only 15 rupees. So in excess of the fair market value, whatever has been issued, clause 56(2)(7)(b) would be attracted and the disclosures would be applicable. Similarly, 56(2)(9) is applicable if money is received in advance on a transfer of capital asset, and if such sum is forfeited or negotiations do not result in a capital asset, then same have to be considered as taxable under income from other sources. So this is the section. Now 29A requires the tax auditor to report the nature of such income and the amount involved. So effective from 1516, we have 56(2)(7). Earlier we had this section 51, which stipulated that cost of acquisition should be adjusted and no income should be reported separately. 29B is on the newly inserted 56(2)(10), not newly inserted recently, but yes, in 2017 onwards, which has widened the definition and considers that whenever an amount in excess of 50,000 or an immovable property whose value, stamp duty value, is in excess of 50,000 is received, then such an amount, such a property or such a value needs to be reported by the tax auditor. Now it said that with introduction of clause 29B, which is 56(2)(10), 56(2)(7)(a) in clause 28 has no relevance. And we would be aware that the necessary rules for computing the values under 56(2)(10) have been prescribed in Rule 11 UA, and the methods prescribed are to be determined by the merchant banker as per the discounted cash flow method or according to the book value of shares. So the question that remains is that whether 56(2)(10) would apply to a newly allotted bonus shares or right prices which are at a price lower than the FMV, fair market value. So we have a case of Sudhir Menon by the Mumbai ICAI, which held that receipt of bonus shares would be merely a split from the existing shares. So bonus shares do not exist on their own. They are just capitalized and they become shares of bonus in terms of bonus shares. And thence there is no enhancement or increase in wealth or property of the shareholder over and above its existing holding. And hence 56(2)(7) should not be applicable. Further, the treatment of bonus shares when one, so there is nothing on rights issue, but one can borrow the necessary observations in case of bonus shares to apply in case of rights issue, and can observe or can say that no disproportionate allotment is made by the company, that is pro rata allotment is carried out in terms of right, which results in increase in the interest of shareholder in the company. And because bonus does not result in increase or enhancement in wealth, but rights is increasing, hence should be covered within the provisions of section 56(2)(10). So bonus should not be covered is what one can take away from this, while rights would be covered under section 56(2)(10) and necessary disclosures have to be made. The clause 30A relates to adjustments made for transfer pricing under section 92 CE. So when an adjustment is made, secondary adjustment is being made, so what happens is that the Indian entity, because of the primary adjustment, has to repatriate that amount to that foreign entity or the foreign AE, what we call. So when one will have to report as a tax auditor whether the excess money has been repatriated within the prescribed time. Yes, then there would be no further implications. If those have not been repatriated, then one will have to impute. When I say impute, there will not be interest which would in reality be there, but one will have to impute such an interest income on the money which has not been repatriated and be disclosed. Similarly comes is 94B, which says that one will have to restrict the interest expenditure paid or payable by an entity to its associated enterprise to 30% of its EBITDA. Now, these provisions are applicable to either an Indian company or to a foreign company which has a PE in India that borrows and pays interest to similar consideration in excess of 1 crore in respect of any debt issued by a non-resident AE. So a debt issued by a non-resident AE would also include an implicit or an explicit guarantee given by a non-AE or a deposit or a corresponding matching of funds with a non-AE lender. So it's not only debt issued, but even a corresponding implicit or explicit guarantee given by a non-AE lender. So a resident borrowing money from a non-resident AE and paying interest to the non-resident AE, but the deduction will have to be restricted under 94B to 30% of the EBITDA. Reporting. So now once we have understood what is the report, what needs to be followed, we move on to the reporting requirements. Now this section is clearly applicable if the expenditure on interest is in excess of 1 crore. So amount, so as a tax auditor, I need to report what is the expenditure of interest. So what is the interest expenditure that is being paid? What is the amount of EBITDA in INR? Expenditure which is in excess of 30% of the EBITDA. Now, whatever is excess of the EBITDA will definitely be carried forward. And similarly, if there is some brought forward, will be added in the current year. So excess gets carried forward, brought forward from earlier years, if any, gets added to that amount to consider 30% during the year. Now, a simple issue. Now, what happens if 94B will it be applicable in only in cases involving cross-border payments where both the lender and the borrower are residents of India and the loan is guaranteed by a non-resident AE? Will applicability of 94B click in? No, because here in case both the lenders and borrowers are residents of India. So hence there is now we move on to clause 30C. Now, as we know that there are two clauses which were deferred. One was 30C on general anti-avoidance measures, which is GAR, and the other is clause 44, which is which is clearly on the GST reporting that one needs to do. So these were the two clauses which were deferred up till now, but these would be first time these would have to be reported in the tax audit report. So GAR, when one says what needs to be reported, one needs to understand what would one mean by an impermissible avoidance arrangement. Now that this is the terminology which has been used which is associated with GAR. So what can I call as an arrangement which is impermissible? Is that the main purpose of such an arrangement is solely to obtain tax benefit, and it should satisfy either of the four conditions given below, that it creates rights and obligations which are not at arm's length, direct or indirect misuse or abuse of the provisions of the law, it lacks commercial substance and is not bona fide. Now, mostly what we have to see is that solely, simple formula is that one has to see that the main purpose is no other arrangement but just to obtain necessary tax benefits, and either of the four below boxes get satisfied, then one can say that it's an impermissible avoidance arrangement. Now we saw that one of the second criteria to be satisfied is lacks commercial substance. Now this is one of the very favorite, I would say, point that the department would resort to, that such a transaction is lacking the commercial substance. Hence we are saying GAR has to be invoked. Now in that case, there is guidance available that when can you say that it lacks commercial substance. So when the arrangement or substance differs significantly from its individual steps or a part. So at that point of time, one can say that it lacks commercial substance. Secondly, when I can say that it lacks commercial substance, is there is round tripping. So I am a party A, I had to make necessary payments to party C, but I don't make payments to party C, but I route it through B, I route it through D, and then D makes it through C. So this is the type of round tripping which could have easily avoided. Then it involves location of an asset or transaction at the place of residence, which is without any substantial commercial purpose. So an asset in terms of shares, securities, whatever it could be, it is located at such a place which is having no commercial relevance except that it is giving me tax benefit. Your tax haven countries are the best examples for this. Or lastly, it is having a significant effect upon the business risk or the net cash flows of any party to the arrangement, apart from an effect attributable to the tax benefit. So these are the four illustrative, I would say, to least, that arrangements that would lack commercial substance. So what are the reporting that one needs to do when an assessee has entered into such an arrangement? Following details need to be furnished. What is the nature of such an arrangement and the amount of tax benefit that is arising because of such an arrangement? So the tax auditor will have to determine the applicability, will have to report on that applicability by determining what is the amount of tax benefit, and detailed analysis will have to be done. So for the support of the tax auditor to carry out the necessary analysis, Rule 10U is prescribed. So it has a threshold. So GAR is not applicable if an arrangement is below threshold of INR 3 crores. So wherever your arrangements are in less than 3 crores, you can skip the applicability of GAR. And as I mentioned that this is going to come up for the first time, hence the reporting needs to be carefully perused if any arrangement has been carried out in the case of the assessee. Now clause 31. Now clause 31 is in relation to 269T, ST, SS. So these are those series of transactions where the assessee would have taken or accepted loans or deposit, or there is repayment of such loans or deposit. Then what needs to be reported? So these also need to be reported if these have not been obtained by way of an account pay check or a demand draft or certain other modes, one would say digital modes, which have been prescribed in the rule, such as NEFT, all those have also been covered. So the basic purpose of reporting this clause is wherever if there is any cash loan given or any repayment also which has been done in cash to a person in a single day, in aggregate, in respect of a single transaction, on an event or an occasion, etc., are the other conditions which one will have to see. So what are the reporting requirements which we are to focus today? So each receipt, otherwise than by way of the mode of transport, so we would call them by way of cash in simplicity terms. Then one will have to report the address, PAN and name of the payer, nature of transaction, amount of receipt, date of receipt. In terms of 269 ST, again we have to report only the name, address and amount of receipt, amount of payment, date of payment, etc. under various clauses of 31 BA, BB, BC, BD. Now what are the special features of 269 ST? So it doesn't make any classification between capital receipt, revenue receipt, between whether the income is taxable or exempt or outside section 4. There is no distinction between business purpose or personal purpose. No exemption with transaction of close relatives or for even agriculturists to say that. So this is a very stringent reporting section which the department wants the tax auditors to report irrespective of these criteria. So this is for your chapter 6A deductions or the exemptions or the exemptions that we have in section 10A, 10AA. So section 33 which speaks about your chapter 6A deductions. So an auditor would have to necessarily report for your chapter 6A deductions under 80G or something of under chapter 6A. Now what is essential is that the requirement of 80G donation eligible provided the donee has issued form number 10BE to the donor. So with effect from 21-22 financial year, there has been an additional condition that the donee has to be issued form number 10BE to the donor. So as a tax auditor, we need to analyze that, we need to obtain necessary details that whether this form was issued or not and do the necessary disclosures. The next is on clause 34, which is the famous clause on details of deduction of TDS and TCS. So as we know that there has been amendment and an additional provision of 194Q has been introduced, which is very applicable on all businesses where there is purchase by any person being a buyer who is responsible for paying to a seller. So any purchase of goods whose value exceeds rupees 50 lakhs in any previous year will have to deduct 0.1% of such and sum. So this is one of the important sections that one will have to keep in mind under section 194Q when one is analyzing the tax audit under clause 34 disclosures, because this has been recently introduced. Then maybe assessees who may have not deducted, or there may have been defaults on not understanding the provisions properly. So we will have to have our disclosures done after due analysis. Similarly, with effect from 2021 under TCS and TDS 206 AB and CCE were introduced, which says that TDS and TCS has to be deducted at a rate higher in case of a specified person who has not filed its income tax return in the preceding 2 years. So so this type of section is applicable in case of non-filers of the tax returns. So a higher rate. So one has to be specifically careful that in case of non-filers, whether the necessary TDS or TCS had been deducted or collected at the higher rate and disclosures is made. Clause 36 is on deemed dividend. So what does one mean by deemed dividend is we are very well aware that payment made by a private company in which public are not substantially interested by way of loan or advance, then in that case it would be known as deemed dividend. So what is the issues? So this is a very litigative section, as one knows that a shareholder has to be registered as a shareholder or beneficial shareholder or both. So it uses the word shareholder. So what is one to consider? So the court said in Madhur Housing and Development Company, the Supreme Court, that provisions of 222E are applicable in case of registered and a beneficial shareholder. So one need not be only single, but it has to be both registered as well as the beneficial shareholder. But Supreme Court recently in 2018, in case of National Travel Services, said that a shareholder has only to be a person who is the beneficial owner and need not necessarily be a registered shareholder. And it said that Ankitec's decision required consideration. So Ankitec had in above relied upon Madhur housing. So in short, it said that one will have to relook at this question. And currently, what stands is that beneficial owner, one has to be a beneficial owner and not a registered shareholder. Clause 42. Now, this clause 42 is very much relevant in terms of the necessary compliances that one does in terms of form number 61, 61A and 61B. Now 61 is a declaration, is a half yearly declaration that an assessee is required to do, and similarly the other necessary form that one needs to see. So as a tax auditor, when we are disclosing whether the necessary compliances have been done, we need to obtain from the client the necessary details, whether these forms were applicable, were duly filled in with all the necessary details, and then reporting has to be done. 61A, the most popular statement of specified financial transactions that one needs to report as an assessee. So tax auditor needs to ascertain whether disclosures have been made. Similarly, we'll just run through this. So this is, so on the screen currently is the reporting format. So income tax department reporting entity identification number. So that's the reporting number that is generated. The type of form 61A, B, whatever is it. What is the due date of furnishing? So we had May, and for 61A, so on and so forth. The date when it is furnished. So it's very essential whether the assessees are furnishing the forms on the due date or not. And the form contains all the details. So tax auditor has to report whether they have complied on time within the due date, if not, when, and lastly, what all details of transactions, what all information had been reported, and list down those. Then we move on to the penultimate clause, which is the CBC reporting clause 43. So this is in respect of an international group. Under section 286, the assessee or its parent or the alternate reporting parent would be liable to furnish a CBC report, and in that the following details have to be provided. Where a report has been furnished by the assessee or the parent or alternate. First, whether a report has been furnished, what is the name of the parent entity of that international group, name of alternate reporting entity in case if that has been nominated, and the date when such a CBC reporting has been complied with. Now, before we move on to a short break of 10 minutes, we would like to discuss the last and the most important clause 44, which is being newly introduced. So this is the general reporting that is expected from a tax auditor during the tax audit in the current year. So what is required is breakup of total expenditure of entities registered as well as not registered under GST. In that, one has to report what is the total amount of expenditure incurred during the year. Then there are two bifurcations under two columns: expenditure in respect of entities that are registered under GST and expenditure relating to entities not registered under GST. So not registered under GST is just a simple one column where an aggregate amount can be posted. But when we come on to entities registered, then there is further reporting and there is detailed bifurcation under four columns. So what were the amounts which were pertaining to goods or services which were exempt? What were those amounts that were from entities which were falling under composition scheme? What were those amounts which were relating to registered entity? And the payment that has been finally made to the registered entity. So this is the reporting that is expected. It is obvious that since this is the new reporting and it's a detailed reporting, one would necessarily have certain questions. So I have tried looking up various common, or I would say the most common issues or questions that one would arise on seeing the disclosure format. and I have just given certain clarifications basis the guidance note, what can be expected or what is best expected. So first point, when I say total expenditure, breakup of total expenditure. So what do I mean? I have to mean total expenditure when I say headwise expenditure, or I have to club all the expenditure. So clarification clearly says that total expenditure including purchases have to be reported. Second is, one would say that if I see my expenditure in the P&L, I have certain items such as depreciation, bad debts, etc. Should that also be reported? No. So these are not outgoing or non-cash expenses. So depreciation, bad debts cannot be said to be expenses. So hence these are not to be reported. Clear. That's a very clear thing. Next is, what about salary or remuneration that one pays to employees? So should that be also covered? So it says that as per CGST Act, a remuneration or salary between an employer and employee is not treated as supply of goods nor services, and hence one should not report such an amount in the clause 44. Next is, what does expenditure relating to goods or service exempt from GST? So we saw those 4 columns under a registered entity. First one was report goods or services which are exempt from GST. So as a tax auditor, I need to be updated with the rates and exemption notifications that the CBIC issues, that which all items, which all goods, which all services are exempt from GST. Has those been correctly classified, and the expenditure pertaining to that I have to report under here. So what is essential is following to be reported. So alcoholic liquor, petroleum crude, high-speed diesel oil, motor spirit, natural gas, and aviation turbine fuel. So these are the items which are not currently under GST, and these have to be reported. So that is what the guidance note specifies. Now, what does column 4 state? Composition scheme. So the tax department wants us that as a general practice, even small and medium taxpayers from whom these expenditures are done or are there, the tax auditor has to give a suitable remark and has to compute the expenditure which is in relation with those entities who are opted for composition scheme. Column number 5 is for registered entities. So value of inward supplies other than composition dealers and exempt supplies are to be mentioned here. So exempt supplies are covered under 3, composition under 4. So hence, but obvious value of inward supplies of a registered dealer apart from these two would be considered in column 5. Column 6 says what is the total payment to the registered entities. Now breakup of total expenditure only was expected to be reported. Now what does the word payment mean? So guidance note says that word payment is harmoniously interpreted as expenditure of the 3, 4 and 5 column, which is payment for exempt supplies, payment for composition scheme, and payment to a registered entity. So sum total of this all 3 expenditures, whatever payment is being made, that needs to be reported. So hence one need not be confused that total payment to registered entity would mean that column 5, whatever amount I am disclosing, that only needs to be reported when paid in column 6. No, expenditure in 3, 4 also needs to be reported when they are paid. Now expenditure relating to entities not registered under GST, yes, one will have to see the inward supplies received from unregistered person and have to be reported. And column 6 and 7 will have to tally with column number 2, except to the extent of expenditure mentioned in serial number 2 and 3. Last but not the least, the contentious issue is capital expenditure. Since the word used is expenditure, what does it try to cover? Does it try to cover only revenue expenditure? Does it try to cover capital or both? So hence the guidance note says that it is necessary that capital expenditure should also be reported, and there should be separate report. So one should not combine as a line item including revenue and capital. One should say that capital should be reported separately for ease of reconciliation. So whenever there is any query or something of that sort, one at a later point of time is able to ascertain that this amount was reported for capital and this for revenue. So with this, I have completed the overview of the necessary clauses and the issues in certain clauses, the overview that the tax auditor should keep in mind on certain important aspects. And with this, we can have a short break of just 5 to 10 minutes and assemble back by 6:10 to continue with the latter part of the presentation on the amendments, the points to be noted, and the checklist that one as an auditor should keep in mind with the necessary clauses. Am I audible as an So yes, the organizers have mentioned that we can have the questions taken up at the end of the session so that we have continuity in flow. But I would recommend that all your questions, you all can put it down in the chat box or the question screen, and those will be collected and be taken up at the end of the session. Once we complete through the entire presentation, we'll take up the questions, and of course subject to the availability of time. So with this, we just break for a few minutes and we assemble back at 6:10.
Okay, sir. Noted. So welcome back, sir.
So we'll just start in a minute's time. We'll let the
Yes, sir.
participants come back.
Yes. Yes, yes.
I have reshared my screen. Please, can you just
Yes, sir.
confirm
It's
if
showing relevant
the screen is
amendments.
visible at the slide? Correct, correct.
Go to second page or something. We'll just check whether it's navigating. Hope it's not passed.
Yeah,
As
I
of
have
now, I'm
moved on.
seeing relevant amendments. Now I can
I-
see relevant amendments point bulletins like change and due dates for filing returns and
Correct,
etc. So you can start, sir, if there is any letting.
correct, correct. So, okay.
Thank you.
So I'll begin there. So as I had mentioned that certain relevant amendments will be covering from Finance Act 2021, which are definitely applicable for us, as well as 3 amendments from Finance Act 2022, which are definitely applicable, which are applicable to us because those have been mentioned to be clarificatory in nature. So what are these amendments? And when I say Finance Act 2021, the first and foremost essential amendment is the due date, which every one of us by this time would be aware that for tax audit report, it has been preponed by a month, or rather I would say that the tax return has been postponed by a month to make it 31st October, and the tax audit report remains at 30th September. So now there is a gap between an assessee having to file its tax audit report first, definitely, and then subsequently its tax returns. Then what comes is the next important amendment from our tax audit application is the threshold limit. As I mentioned that it has been increased to 10 crores from previously 5 crores, but there is a rider that the transactions should not exceed, the cash transactions during the year should not exceed 5%, payment as well as income, receipts as well as expenses both. The other important amendment that I would say which is applicable is depreciation on goodwill. So we have seen that there has been an amendment which has clearly said that depreciation on goodwill is not available, and hence as a tax auditor we will have to make sure that the block of asset for intangible asset is duly recalibrated to not consist of that goodwill on which depreciation will be applicable. Then the other one is presumptive taxation. So as a tax auditor, as one knows, one has to report whether presumptive taxation has been opted for. So earlier 44 ADA was applicable to all resident assessees, individuals, AOP, BOI, HUF, etc. You have to be a resident in India, and now it has restricted that only resident individuals and partnership firms are eligible for presumptive taxation under section 44 ADA of the Act. The other important amendment is 194Q, which we saw that on, well, if the turnover exceeds 50 lakhs, then 0.1% TDS has to be deducted, which we have discussed. We'll have to be very mindful of this amendment and its necessary implications, whether the rate is proper, whether the threshold one is considered in terms of the CBDT circulars, notifications that were issued. Next is special provision for TDS and TCS for non-filers of income tax return. This is also an amendment which one will have to consider because the rates would definitely vary if you are a non-filer, and necessary reporting will have to be done. 194P has been introduced in case of senior citizens. So deduction of tax in case of specified senior citizens after giving effect to chapter 6A in case of you, or if you're 75 years and above. So that is 194P, which has been recently introduced. So that also needs to be taken account, though that may not be of much applicability when it comes to tax audit, but that's an amendment. And lastly, which is the crucial of all amendments which I would want to discuss, is employees contribution, which is to various funds such as your PF1, your ESIC funds, etc., which were up till date being allowed if you had failed to deposit by the due date of the fund, which is 15th of the month, whatever was the due date prescribed. But if it was made before filing of your return of income, one could claim that amount as allowable, and that was no such disallowance. But strictly speaking, now there is a specific amendment which restricts that there will be a disallowance if the amounts are not deposited with the fund on or before the due date of that specified fund, and not till the filing of return of income. So as a tax auditor, we have to be mindful of that. Though what we were expected to report was the due date of the fund on which we were supposed to deposit and the date on which it is deposited. So that may continue to remain the same. Now, these were the relevant amendments from the Finance Act 2021. Now, there have been 3 amendments which I said from the Finance Act 2022, which has been introduced in a clarificatory manner. When I mean clarificatory manner, means that these are saying that these will have a retrospective application. So when I say retrospective application, means even though they are from the next year onwards introduced, should be applicable, but since they are clarificatory, one will have to analyze these implications during the tax audit reporting of the current year as well. So one of them is 14A, which we covered, wherein we simply stated that even exempt income, if you are not on exempt income, the necessary disallowances will continue to be made. 37(1) also we considered, wherein it was mentioned that penalty or fine for violation of law. Now, what is that law? Is not only Indian law, but it is also applicable to foreign law. And lastly, 43B. So 43B used to restrict certain deductions which would not be allowed. So clarification has been introduced that deduction will not be allowed on conversion of interest liability into other debt instruments. So if you have an outstanding interest, you convert it into a loan, that deduction will no longer be continued to be allowed, and that has been clarified. So these are introduced by way of clarifications because there were certain judicial precedents, there were certain, I would say, because of court decisions, there were certain stand or favorable rulings that the SSC were adopting and were taking favorable benefit out of it. So now, because of a clarification introduced, the government has said there's a full stop to it, and hence these have been introduced by way of an amendment. So these were the relevant amendments that I wanted to discuss. Now we move on to the miscellaneous, that is the case law updates. We will not get much into details with all the necessary case laws. We'll just skim through them. So I have as it is, the slide will be shared by the organizers, so you all can go in detail with the necessary clauses on the left, the main crux, what was the issue, and the necessary case laws that one can rely upon when there is a contentious issues. So most importantly, we have the second one on the screen. So in Supreme Court, in case of Smith Securities, that said that depreciation on goodwill is to be allowed, but since that seems to have been overruled by way of an amendment, and goodwill can no longer be allowed, depreciation can no longer be allowed on goodwill. The next one would be that lessee cannot claim depreciation in the absence of legal ownership. To avail the benefit of depreciation, lessee has to undertake the construction activity himself. So this was held in Mother Hospital Private Limited by the Supreme Court. Routers and switches, so both these points entitled at higher rate of depreciation at 60% has been held by various case laws, but now the depreciation has been restricted to 40%. Additional depreciation, and most important is contribution to approved gratuity fund, employees group gratuity fund to LIC. Approval is pending eligible deduction. So this will again undergo a change in light of the necessary amendments being made. Similarly, clause 21A, expenditure on repairs of rented premise, even if huge and accumulated, it will not be classified as capital expenditure. They would be allowed as revenue expenditure as held by the Delhi ITAT in case of ICAI trading. Then we have that there may be cases when you make such an expenditure where a project does not materialize and has to be treated as a revenue expenditure and not as a capital asset since it did not come into existence. Manganese ore is the case law decided by the Bombay High Court. I would say very contentious issues, or I would say very famous issue in case of all the telecom entities, in that discount given to SIM card distributors on prepaid cards and payment for roaming charges are not liable for TDS. So department very infamously holds that these are in the nature of commission, but the courts have time and again held that discount given for SIM card distributors on prepaid cards and payment for roaming charges would not be liable for TDS. No disallowance under section 40A IA for reimbursement of expenses by an agent on behalf of assessee when the TDS was complied with by the agent for and on behalf of the assessee, which is the principal. 21B, so Kerala High Court in PVS memorial states that if withholding of taxes is done under a wrong provision, then disallowance under section 40A IA will be attracted. Then Delhi High Court in Ericsson Communications states that mere passing of book entries, which would be at particularly at the end of the year and reversal at the start of the year, would not give rise to an obligation to withhold tax by the payer in case of transactions covered under section 195. So this is specifically said in light of 195 provision. Now there are certain decisions which are for and against by various courts and tribunals on provisions made at year end, whether TDS needs to be deducted or does not need to be deducted. One can take a stand depending upon the jurisdictional court's decision that what is more beneficial and then make necessary disclosures. Similarly, 21B Bangalore Tribunal holds that in Cerner Healthcare that reimbursement of expense can never be said to be income in the hands of the recipient and TDS is not required to be deducted. B again, Mumbai ITAT Band Global, royalty in case of computer software. So this will have to be analyzed along with the decision of the Supreme Court in the recent case of engineering analysis, wherein Center of Excellence of Engineering Analysis, in which computer software and royalty have been dealt very much in detail and the necessary withholding of taxes. 21H, 14, a disallowance cannot exceed exempt dividend income may again come under scrutiny because of the amendment which says that disallowance cannot be restricted to dividend income irrespective of the exempt income earned. One has to make the necessary disallowances. So all the decisions of 14A which were very well settled till now, that no disallowance when the exempt income if it exceeds the exempt income, or where there is no exempt income, will undergo changes in light of the amendment made. Now this is important that Mahindra Kumar Badir in ITAT Jaipur, it was held that in view of CBDT circular of 6 of 2016, if assessee consistently shows it shares as an investment and offers capital gains, AO is not entitled to urge that the same constitutes stock in trade and assessee and assess gains as business profits, that there was substantial and frequent transaction and motive was to earn profit. So this is a very common issue. Someone who is not into stockbroking business or share trading business, but normally as an assessee one would regularly deal in shares. So in terms of the CBDT circular, there are certain factors laid down: the frequency of dealing, the profits that one makes, etc., etc. One has to take a stand whether it wants to be assessed as a business income, or one wants to be assessed as capital gains. So depending upon what is more beneficial, the assessees take the necessary stand, and one has to stick to it. So if your assessee has opted for being taxed as business income, then this would be categorized as turnover. Definitely what is more essential as turnover is because F&O transactions, what is turnover is not only the profit that one makes, but the entire profit as well as loss. So both add on become your turnover. So that is very essential when one needs to categorize or consider in terms of the CBDT circular. So these were the general, I would say general decisions on various clauses that have been helpful to take a particular stand while doing necessary disclosures. What is essential is now what do we do? Once we have understood the necessary provisions and necessary reportings, how should one be careful? What should one include in the to-do list or checklist so that we don't miss out on calling for certain documents or details or taking certain representations from the management? But before we get on to that, it is essential that we understand the audit procedure. I would be very confident that each one of us would be following it, but just let us quickly take it through that there would be an appointment, engagement, one understands the client, one would do planning in terms of materiality, risk assessment, then comes the execution where we are currently, that the audit program checklist would be established. Basis that one calls for the details, representations from the management, necessary certifications, etc. Tax audit is completed, reporting, tax audit report is issued. Most essential that one needs to be careful, UDIN has to be put in, which all of us are currently following, and then we close it with our billings and collections. So a general audit procedure. So what are the general checklist or to-dos or suggestions that in my opinion I can share? Essential that we document that we have the engagement letter and acceptance of the client, since sometimes or many times it happens that we are the statutory auditors, we have the statutory audit assignments, and then we are complying with the tax audit as well. So we necessarily need to document that we have the engagement letter and acceptance from the tax audit point of view also. In case there was a previous auditor, we were not the tax auditors, then the NOC. So these are general guidelines keeping in mind the professional standards that are applicable to us. Reconciliation of figures disclosed in the TAR vis-a-vis the figures in GST returns, TP reports, income tax reports. Why is this very essential is that I have seen that the department raises additions, queries, etc. basis that you have reported in your GST returns X amount, which is not matching with your income tax return, or which is not matching with your tax audit report, the turnover that you have disclosed. And hence we feel that there has been underreporting or escapement of income if there is reopening, or normal queries where they say that you have, I would say, misreported or underreported your income. So these are very essential that we have an overall look as a tax auditor. We call for all the reconciliations in the GST returns, in the TP reports, etc., and then we put in our figures over there. Ensure that we have valid digital signatures, which is now in post-COVID era, we have all been very up to date with the digital signatures. Essential to check that the client is able to log into the website and to avoid last minute ditches. So this is with digital signature and the website, I am reminded that sometimes it happens that the client's digital signature is not reflected or doesn't get updated, and at the last moment we have these glitches. So we avoid that. We see the validity of the digital signatures as well and keep it updated. We compare it with last year's audit report and audit observations and maintaining consistencies. We see what were the list of inadmissible expenses, because those are very crucial, because once these are reported by the tax auditors, the assessing officer will definitely try to look for it in the income tax returns, and for any reason these are not falling in place in the income tax returns, then at the time of processing of returns under 143(1), there is bound to be a variation. Stock statement, yes, definitely one has to obtain from the client. Now what I understand is that the current clauses of tax audit report require reporting of all the quantities that the assessee has in terms of stock. The guidance note somewhere mentions that key or principal products or quantities need to be reported, and for that the tax auditor will have to necessarily obtain from the management what it classifies as key or principal products or quantities. In terms of example, when I say if it contributes more than 10% of the contributions or the sales, one can classify it as a key product or and report those quantities. Certificate from the auditee for loans and repayment, yes, this is important to put in our audit trail file. Balance sheet P&L should be signed by both the auditor and auditee and scanned and converted to PDF. And finally, yes, bill for professional fees before we move on to the next assignment. Now this segment, which is probably our last segment to deal with before we move on to the questions, is as an auditor what I face in terms of typical issues under various clauses that we will highlight, that we will try to deal with in this segment. So clauses 1 to 8, fairly simple clause, reporting factual information. But as I said, most important is whether a tax auditor is required to opine on the applicability of indirect taxes. We got support from the guidance note, which clearly says that the tax auditor is not required to do that assessment, whether applicable in indirect taxes are applicable or not. Take representation from the management and do the necessary disclosures. Clauses 9, 10, 11. So we know what we need to report, but what we need to obtain is what I will highlight here. We need to obtain a copy of partnership deed or deed of constitution as applicable. If the books or records are maintained in computer system, essential under clause 11, where are those books maintained? So sometimes what happens is nowadays all necessary companies or corporates will maintain their books of accounts in computerized system. We need to maintain whether these are maintained at the principal office, whether they are maintained at some other registered office, because the Companies Act provides them certain leeway to maintain apart from the principal office. And yes, definitely the tax auditors need to report the location of server or principal place of business of the assessee. Location of server is paramount important because there are many other provisions which are linked in the Income Tax Act which clearly highlight that the location of server will play a very important role in terms of the SEP provisions or whatever the department plans to introduce at a later point of time. Clause 12, when I say one needs to scrutinize the books of accounts and ascertain what are the profits assessable on presumptive basis. So this is for presumptive section and should be indicated, not only credited to the P&L needs to be disclosed, but amount which is assessable under the relevant sections need to be disclosed. So there can be certain circumstances because under presumptive, if we have 8%, 10%, the profit margin which is mentioned, 50% of gross receipts. So it covers certain types of expenditure which are subsumed when I say that 50% is my taxable profit under presumptive. So one needs to be careful that I don't include certain expenses which were already considered. Clause 14 is on valuation of inventory. So obtain the basis of valuation of inventory for reporting on the method of valuation of closing stock. Ascertain the cost and basis. If the tax auditor is similar as the year-end auditor or the stat auditor, then it becomes a simple process because one has done that procedure. But if it is a different auditor, one may have to do certain extra procedures to rely upon the valuation arrived on 31st March. Special provision with respect to section 50C. Now this section 50C is applicable in case where property, land, building or both have been transferred not at the stamp duty value but at lower than stamp duty value. So what we need to keep as a record to ascertain the details as well as a backup in a backup files. So properties that were transferred, what was the actual consideration received? Sale document, what is the assessed value, which is the stamp duty value? If registered, then what could be the implications? And when no such documents are available from the relevant authorities, then necessary caveat or qualification has to be made in the necessary observations of the tax auditor. Clause 18. Is my screen on clause 18?
It's in clause 18 typical issues only, sir. Yes.
Sure, thank you. So clause 18 is the depreciation schedule. So we have, so this is very essential that we look into the previous year's depreciation schedule in terms of the closing WDV, that amounts are carried forward correctly. Additions in terms of half yearly, yearly depreciation should be calculated properly and have been inserted. Most essential, one has to take care again to reiterate, intangible block of goodwill will have to be recalibrated if there is one. Fixed asset additions are correctly classified in term as per the necessary block rates and depreciation, and additional depreciation as and where which has been claimed should be disclosed or should be disclosed in clause 18 properly. One will have to be aware that if one opts for the new tax regime, then there are certain conditions which stipulate that certain type of depreciation will not be available. Those should not be claimed. Recommended note. So this is just a recommended note that has been reproduced from the ICAI guidance note in terms of dispute with the tax authorities on the rate of depreciation, etc. Exclusion of goodwill, as I mentioned earlier, will have to be taken into consideration. Clause 21 penalty. Auditor is not required to give an opinion whether this amount is a penalty or not. Its impact needs to be justified. One has to be aware whether it is for violation or a breach, for breach of a law, or is a breach for a contract of payment. If it is breach for contract of payment, then it is not required to be reported. Sometimes it may happen that there is penalty which has been leviable, but the assessee may say that we have contested this penalty before the various authorities, and hence this, and we are very confident of succeeding, and this should not be reported. But still, the guidance so specifies that the tax auditor has to disclose this amount of penalty even under dispute. Provided that such a disputed amount of penalty is debited to the P&L. So this is generally, I'm skipping through because it is same as what one discussed earlier. What type of penalty or fine, whether infraction of law in India or abroad, also is to be considered. So this is essentially a penalty imposed for violation of any law during the course of trade cannot be described as commercial law. Even if the need for making payments has arisen out of trading operation, the payments are not wholly exclusively for the purpose of trade. So one cannot classify penalty as a commercial loss and try to hide it. The substance over form will definitely take over, and as an auditor, it's our responsibility to get to the nature and then make necessary disclosures. Clause 21 starts with 14A. 14A, legacy issue, normal reporting is to be done. Only thing needs to be taken care of, that sometimes the client may say that we have not earned any exempt income, or so on and so forth. So we need to be very much aware that there has been an amendment, and definitely as per rule 8D, one will have to determine the disallowances suo motu. And as a tax auditor, one need not determine this amount. One has to verify the veracity of the working that the client has made for disallowance under section 14A read with rule 8D. If one is satisfied with the amount, then no disclosure is required in terms of not qualifying the report, but that amount can be reported. But if one is not in agreement with what the assessee wants to report, then either a qualified opinion can be given if it is not it is not so material and pervasive to require an adverse opinion, or in case if the amount of calculation of 14A disallowance is of such nature that an adverse opinion is required, then an adverse opinion be given, or in other case a disclaimer of opinion is given where the assessee refutes to compute any amount, but the tax auditor feels the disallowance is ought to be required. So some of these issues which is applicable under 14A which still remains alive is own fund versus borrowed fund. So one has to be careful that if own funds exceed the borrowed funds, no disallowance should be made. Disallowance in the absence of exempt income, this has been substituted with the amendment by the Finance Act 2022. Disallowance in excess of exempt income is also similar. Disallowance in excess of expenditure claim, so this cannot happen. Overlap with expenditure allowed under other provisions, so there can be certain other provisions such as 37 under which these amounts have been disallowed. Then 14A, another disallowance of the same amount should not be made. Claim for exemption of income be foregone, so sometimes that income which is exempt has been foregone, so in that case one will have to take into consideration applicability of investment capable of yielding taxable income. So this comes from the special bench decision of the Delhi ICAI in the case of Vidit Investments, which has laid down the law and which is almost settled principle that only investments capable of yielding taxable income have to be considered, and definitely applicable to shares held as stock in trade in terms of max of investment. These are also where 14A should be applicable or not applicable is written. Clause 26, which is again essential in terms of 43B, one needs to prepare a thorough reconciliation of what was the amount outstanding liability as at the year end reported, both from the perspective of the financials as well as your tax audit report of the previous year. Reconcile those amounts with the current year, whether the payments have been made or not. If those payments have not been made, then these have to be reported. Payments made have to be reported as payments made during the current year, so that necessary disclosures are in line with whatever is the exact position of payment. So there are certain cases where items for disallowance are to be disallowed irrespective of whether the amounts have been passed through the P&L or not. Further, when the amounts are routed only through the balance sheet, such facts should be stated against the respective item under this clause. So it is imperative that we ask the client and ascertain from the financials whether the amount has been routed through the P&L or not, and it has to be disallowed. But once the client says that this has been routed through the balance sheet, if it is routed through the balance sheet, then necessary caveat has to be inserted in the clause. Clause 28, we saw for 56(2)(7)(b), when shares are issued at more than the fair market value. So what all details we need to call? We need to call for a valuation report. We need to refer to Rule 1111 UA. We need to understand whether the fair market value has been correctly computed in terms of the valuation report. If it is from a merchant banker, we can definitely rely upon that report. And there is no need to travel beyond the books of accounts. Similarly, share premium verification from books reliance on the valuation report. Obtain a list containing the details of shares issued. Clause 32 says losses that have to be carried forward. So no loss is to be carried forward unless the return of income of that year is filed on or before the due date. So one needs to be aware that the losses that the client gives us to carry forward and to be disclosed are those losses where the return was duly filed within the time limit. If there is any intimation or order by the department which has assessed the loss at a lower amount, then that losses need to be reported unless the return figures, and one needs to reconcile with the amounts reported from the previous year to be in sync, that losses that are being reported continuously year after year, there has not been any change, unless of course there is an assessment done which has reduced the assessed loss. So with this, the typical issues I have covered. I'll just give you a brief recap before we move on to the questions. We'll have roughly 10-15 odd minutes to take up the questions. So what we saw was the basis of applicability of tax audit. Tax audit has been applicable for almost 40 odd years now. We understand what is tax audit required, but then why is an overview of tax audit required is because there have been constant amendments, constant changes in the law, constant updates from point of view from courts and tribunals, variation in the form itself with numerous clauses. Hence, it is imperative that we overview the tax audit requirements currently. We saw the tax audit applicability. If it is applicable, if the turnover exceeds 10 crores, then tax audit is applicable. Presumptive income, we saw the various criteria therein. once the tax audit is applicable, we saw various clauses. Part A clauses are simple. Part B clauses, we need to be very careful of two important clauses. 30C, which is on GAR. Those may be applicable only if there are any specific arrangement which the assessee has entered during the year. If not, then that clause may not be applicable. But yes, definitely clause 44 is applicable in terms of GST, the breakup of total expenditure which has been made. And there is a detailed guidance note apart from the summary that I have shared. I would request each one of you to read the guidance note, especially for clauses 30C and clause 44 where applicable to the assessees, to have the first hand idea about what detailed guidance note has been issued on both of these clauses. And then finally we saw that what are the relevant amendments that one needs to be careful of. Those in Finance Act 2021 are fairly applicable to us, but that amendments in Finance Act 2022 on 14A, 43B, and one more on 3615A, what those three amendments, they're been issued clarificatory in nature. And 37, sorry, my bad, 37 has been issued on foreign law, Indian law. That needs to be carefully taken consideration of. One more, there is an amendment in 37 as well, which states that many people, especially especially relying upon the various high court rulings, had claimed education cess. Now, if there has been any claim of such education cess, one needs to disallow that and make necessary disclosures wherever applicable, so that if we are in line with the clarificatory amendment that has been introduced. Then we saw as a final segment after the amendments, what are the to do or the checklist points that one needs to be up to date with. Sometimes it may happen that we may raise the queries and we get certain representations from the management. There are certain issues where we are not supposed to get into verification, such as applicability of indirect taxes, etc. Rely on valuation reports, so that we need not get into the depth of it, while we can rely upon whatever reports or details are submitted. But yes, definitely one needs to document those facts or those documents that are available from the client. So with this, I have covered the overview of tax audit, and I'll be very happy to consider the questions.
Sure, sure. I'll share my screen. I hope the Excel sheet is 6 questions which can be taken up, and we'll unmute participants also. They can unmute and ask. My screen visible, sir?
Yes, it's visible. So the first question says daily share trading, what is the turnover, whether it is not net or gross? Share trading, there is no specific. So I mentioned about the F&O segment. So dealing in derivatives, etc., for that the guidance note prescribed that the turnover should be the profit and loss. So it is not for share trading what is applicable. That was for the F&O segment that I had specifically mentioned. How to report on the next question? How to report headwise expenditure in clause 44? See, clause 44 as of now is new to all of us. What we understand is that they are asking breakup of total expenditure. So we have to report the total expenditure including the purchases. So not only the P&L items, excluding the purchases which are just the expenses, but including purchases that one needs to be reporting in. In my recollection, the guidance note doesn't say party wise we need to report. What we need to report is expense wise. So aggregate all the expense head needs to be reported. And specifically, yes, when I'm mentioning expense wise, one needs to report capital expenditure as a separate line item. In export sales, shall the foreign fluctuation be considered as the turnover? Can you just read this question in the export sales, because I can't read the latter half.
Export sales shall be forex fluctuation considered as turnover, or it shall be considered as profit and loss item.
So forex fluctuations, one will have to resort to the guidance note. What does it say? So there are two types of foreign fluctuations that could arise here. One would be that foreign fluctuations which have been realized. So those in my understanding should be included as turnover, subject to the tax audit, subject to the guidance note. But what should be the position when I say that forex fluctuations which have not realized and which we are doing to be in line with the accounting standards or to be in line with the Ind AS? So that one will have to see from the guidance note what is the specific guidance available on unrealized forex fluctuations. During the course of business, assessee, please can you help me with this question as well? This is a long question. Hello. Hello.
Yes, sir. Tell me, sir. Next question, sir.
Yeah, just can you help me with reading? Because of the
During
screen, I minimum.
what happens, sir? Are you not
So
able to?
yeah, yeah. No, I was not able to see the screen. Okay, now I can view it. During the
Please.
course of business, assessee purchased goods on credit. Subsequently, he is unable to pay the dues. Hence, he agreed to convert the outstanding to unsecured loan. In this case, shall apply section 269. So currently what we understand is that section 269 reporting or section 269 per se covers, the intention is to cover loans as well as advances which are in the form of loans. So what has happened is these were goods which were given on credit, and since we were not able to realize the dues, hence has been converted into outstanding to unsecured loans. Now I fail to understand per se that when you are not able to repay the dues, whether converting them into unsecured loans, what would be the benefit? One would rather put it as bad debts rather than putting it as unsecured loans. So I am not able to understand if the rationale behind this. So that's it. That's what is income from investment not included are also to be considered in the tax audit report. So income from investments not included. So it was very categorically said in the guidance note that the turnover will not include your investment income. So if it is not if it is included, it's not supposed to be included if you are not into the business of investment, share trading, etc. But what if you are in the nature of share trading and you have income from investments, if you have not included, then definitely your sales and turnover, or sales and turnover, what has been defined is whatever services that you have rendered or whatever goods that you have sold. So it never mentions that should be whatever is reported in the books of accounts that you need to consider as turnover, is my understanding from the guidance note. But given that this is not what has been defined anywhere in the act, so could be a contentious issue. Do we have any files or reading material or presentation? Yes, definitely. Once this presentation is done, we will have my presentation being shared, and I will share my contact details. So I'll be definitely available if one wants to get in touch with me for any further questions as well. Ineligible ITC expenditure to be reported basic or gross. Does cash receipt include cash withdrawn from banks? So yes, so to answer this, ineligible ITC expenditure needs to be reported. Now there is a conundrum that whether eligible ITC expenditure, what all should be reported or not reported. So sometimes what happens is one position that which one can take is that ITC expenditure which has already lapsed, should I report that? When the clause mentions, when the clause is not very much explanatory that what type of expenditure I need to mention, so one can take a position that such such a ITC credit was never available to the assessee, hence these have not been reported. Does cash receipt include cash withdrawn from banks? Now cash receipt, now I would say that cash receipt, what would one be considering as for the turnover or threshold limit, or generally in per se? I am not able to understand that. But yes, definitely if I am to give you a general answer to it, cash receipts may not consider cash withdrawn from banks because that would have already been accounted once earlier as my receipt. So again, just because I have withdrawn it from banks, I may not have to say that this is again my cash receipts. Simple words, I don't have to count a particular source of income or receipt twice. If I've not done it earlier and withdrawing in cash, then I would suggest that one should include this as your receipt. But if on deposit in the bank, this was already considered, then one cannot say that this is again a cash receipt once I withdraw it. Did understand the concept of own funds and borrowed funds? Yes. So the concept of own funds and borrowed funds is typically applicable in case of section 14A. Now what happens is that 14A disallowance happens for when you make certain expenditure or the department says that you have made certain investments to which you require certain expenditure to maintain. So that is one aspect of it. And then there is certain borrowings that you do and you pay interest out of that. So you take loans, you pay interest on that, and out of that funds or out of your own funds, you have invested in certain investments and you are earning exempt income. So the department will say, or the provision says, that such interest will have to be disallowed which you are paying on the borrowed funds, because investment was made out of such funds which was directly attributable to such funds. So hence it has been a general practice or a general line of defense that is taken, that whenever we prove that borrowed funds, that the investments have not been made from the borrowed funds. For example, borrowed funds are 100 crores and the share capital, the reserves, etc. are 150 crores already. So we try to take this defense that our own funds were in far excess of the borrowed funds, and hence the assessee did not use borrowed funds for making investments and own funds have been used. So hence it is clearly said that own funds and borrowed funds, so own funds are used, hence 14A disallowance should not be triggered for such a type of interest expenditure. I hope I am able to explain this point on own funds and borrowed funds. Lastly, what are the consequences if the turnover is not matched with the other reports? Yes, so this is the common practical I would say difficulty that one faces later on, not at the time of reporting, but later on. So as we know that the department has become very robust in terms of the issues or whatever they are getting details or data of the assessee from various sources. For example, from banks, SFT reporting happens, your stock markets, your stock exchanges are reporting, various other assessees are liable to report. If you have done a transaction of up to an X amount, you need to report that transaction. So what will happen is that if you have reported suppose 100 rupees of turnover in your tax audit or in your income tax return, and that return does not match with your GST, or in turn your GST reporting in your tax audit column or in your income tax return, we have the last schedule before a part TTI. If that doesn't match, then we have a direct query from the tax department during the assessment that so and so turnover is not matching, or we have got information from your GSTR returns that the turnover you have reported is X amount and your income tax turnover is at the lower threshold. So please explain, or then if they don't find the explanation satisfactory, then the necessary additions are being carried out. Now this is normal addition. Now what in case you are not liable for tax audit because of this turnover threshold, and because of the GST turnover threshold, the amounts were crossing 5 crore, 10 crores, whatever. In that case, if the department is not satisfied with your explanation or reconciliation, there could be implications as high as penalties, which is 0.5% of your turnover, which could be reported, with the department will consider as per your GST returns, or 1.5 lakh, whichever is lower. So hence I can see those consequences as of now. But as we are revolving around, we could see more and more probably what all consequences can come.
Sir.
So I have dealt with the questions. If anyone has further, we have a minute or two to take them.
With the audience, sir, it was interrupted while you're finishing it off. Members, if you have any question, kindly unmute and you can post if any. If not, so we'll wind up the session. or else if there is any questions, you can post to SIRC CP mail ID, or sir will be sharing his mail ID, so you can post it to him, so that can be responded. So we'll be sharing the materials along with the recordings to you over mail, and also posting it on our YouTube channel for the benefit of members. So we'll wait for 1 minute, so if not, so we'll wind up, sir. Okay, 1 minute. I'll just check up if it.
Surely.
And members, the continuation of this session on technology as an audit tool will be taken tomorrow by CAU Saran Kumar sir, the same time 5 o'clock. I kindly request you to join using the same link tomorrow around 5 o'clock for the same. Since it is a continuous session, 2 days course. 1 minute. So there is one question that popped up. With regard to answers, sir, we'll be sharing the recording, right? It will be having the answers what sir has taken up. So it will be easy for you to refer actually. Since the screen is shared and the responses over voice, you can refer the recording, sir. Kindly drop a mail to SIRC CP mail ID. We'll revert with the recordings and also the materials once we receive the same from speaker. So it seems there are no more questions, Abdul Kadir sir, and thank you so much for your time spent here, and also taking up the session on a short notice, which was set in the morning only. And on behalf of SIRC office bearers, chairman, secretary in their absence here, we thank you so much for taking up the sessions and knowledge sharing. We look forward to have you in a physical session in Chennai for the same topic or some other topic when time permits. Sir. We look forward to have
Definitely. It was my pleasure. I would like to thank the entire committee, organizers, for having me to take this wonderful session, and for the audience to be interactive in terms of the questions that have come forward, and to have a patience listening. Thank you so much, everyone.
Yes, there's one more question we'll wind up before that. There's a question that came up just now. Is clause 44 applicable for annual year 2022-2023?
Yes. So what is the situation is that the clause was introduced way back. This clause had been deferred by way of a CBDT notification. That notification mentioned that it is deferred till 31st March 22. Now reporting as on date, it has not been extended. One would hope that it again gets deferred, so we don't have to get into the rigors of reporting. But as the situation stands today, we have a detailed guidance note available from the institute, and the sources suggest that we will have to report it currently. So yes, there is no extension on the clause being deferred once again.
Oh, noted. So those were the questions.
Unless we again hear from, correct. Yeah, unless we again have a subsequent notification coming in September.
Okay. Noted. So thank you so much once again, sir. We'll wind up the session. Thank you.
Thank you so much.